Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. And on tonight's program, Julia Lee of Boom Invest and Jun Bei Liu of Tribeca Alpha Plus will look at the stocks that they like out of reporting season. And then I ask, when do tech and payment stocks rebound? Will it be soon or much later in the year? And then Paul Rickard looks at A2M milk and Wesfarmers, and we ask the question, are they on the way up? And so let's kick off with Julia Lee of Boom Invest and see what she likes right now. Thanks for joining us, Julia.
Great to be here, Pete.
Hey, let's talk about reporting season so far. What do you think of it in general? Has it been a good reporting season?
Surprisingly, the reports have been quite good. We've seen the Australian share market, one of the best performing throughout the world in February, and that's been supported by company fundamentals. I mean, any direction that you see, there's been some pretty positive stories coming through, whether it's the banks or financials from a better pricing environment. And we've seen Bendigo being a standout there, and also the insurers doing quite well, Insurance Australia Group, as well as Suncorp Metway. Or if you have a look at the retail space, where we've seen a great result coming through from JB Hi-Fi, as well as looking at things like Vicinity Centres, which has really blown the lights out. And then I guess, while we have seen some costs rising, especially when it does come to some of those materials and miners like BHP Billiton, Santos and Woodside, what we have seen is a very strong pricing environment coming through as well. So we've seen increasing profitability there. So look, I think this reporting season surprisingly has surprised on the upside.
Julia, I wrote last year, and I've been repeating it, that I thought, well, we're so far behind America in terms of the gains since the coronavirus. And if you compare it to where we were before the pandemic, I think America's market was up about 38%, we're up about 4%. And I figured there's a good chance we might play catch up this year and maybe do a little bit better than Wall Street, presuming that tech stocks don't come good in the back half of this year. But are you suspecting that we'll have a pretty good year on the ASX 200 index?
So far for the Australian share market, it's looking good. And when you think about the composition of the Australian market, the two biggest areas of our market are basically the banks and the miners. And in a rising interest rate environment, you'd expect both of those areas to do well. The banks mean the rising interest rates mean a positive repricing of their books, even though they're going to see some of their cheaper funding sources through government support being taken away. But we certainly saw some of that flow through also for the insurers. And while QBE Insurance are disappointed with its earnings, there's probably a degree of conservatism there. And what we are going to see is rising interest rates providing a stronger pricing environment or an investment environment for those financial stocks. So financials and banks looking good. And then on the other side, when you've got worries around inflation, commodities tend to do quite well. So iron ore's been doing quite well in February with the Beijing Winter Olympics coming to an end. You'd expect some restocking happening. And one of the key commodities that has been doing well is also aluminium. So South 32 is looking quite interesting here as well.
Yeah. Also, Julia, there's a lot of interest in uranium at the moment with, I think France has actually put its hand up for a whole pile of nuclear businesses. Do you think over the next 3 or 4 years we might see uranium stocks do pretty well?
Sure. I mean, uranium had been in a bit of a slump after Fukushima, and that really dampened investment in terms of new uranium power plants, which is a key driver of price. And the thing to be watching here, Pete, is China, which has extremely ambitious plans in the area of using uranium for power generation. So watching China very carefully, given that it's such a big use of power and of course of growth as well. So I think China's intentions in terms of new uranium plants is more than what they've accumulatively rolled out over the last decade. So China, I think, is a key area to watch. We know that Europe has been very progressive in getting to that zero carbon target, and especially areas like France as well. So look, I think uranium well supported, but look, we are seeing that whole energy complex doing well, and that was topped off by a bid for AGL Energy today coming through from Brookfield and Mike Cannon-Brookes.
Yeah, exactly. All right, so I asked you to give us an idea of the companies that have impressed you, that you think are still worth a buy. Just give us a few names then.
Sure, I really do think that commodities will continue to outperform this year. So whether it's iron ore in terms of BHP Billiton, or even if it's oil like Woodside Petroleum old school, or whether you're going through to new school like Paladin in the uranium space, or in the lithium space, I like Allchem at the moment. But also the banking space, I think there's been a bit of life coming into that space. We like Commonwealth Bank and NAB, but also insurance. QBE was sold off on Friday, but we saw a strong bounce back today. And that rising interest rate environment will see its investment portfolio doing a lot better, together with that increase in gross written premiums and also increasing margins as well. So I think that's a very positive story. The retail space also has more to run, especially if they're exposed to that home building area or houses, as we've seen come through from JB Hi-Fi and areas like Scali and Beacon Lighting. And Harvey Norman will be the real test this week, so watching that space as well. But on the flip side, we know that rising costs, labour shortages are a real problem if you don't have a rise in commodity prices to offset. And we saw that in the area of tech today, with A2M shares being sold off quite heavily. So just being cautious around those workforces which have a big people power, because those costs are rising in the area of labour, and labour shortages are also biting into profitability.
Julia, thanks for joining us. Talk to you next week.
See you, Pete.
Catching up with Jun Bei Liu of Tribeca Alpha Plus to see what stock she likes as a consequence of reporting season, and then we might talk about a few companies that have either done well or done poorly today on the market. Good to see you.
Great to see you, Peter.
Yeah, let's focus on the ones you like after, but there are two that bring to mind. You were a big fan of A2 milk until it went off the boil, but you kept believing in it. It's had a nice day today.
Oh, absolutely. Actually, that result was probably one of the first results to really start showing green shoots. Yeah. Not only they beat expectations, that's the first time in probably 2 years. They also talked to pretty good prospects. So they beat, in terms of the revenue, they beat consensus analyst expectations by over 8%. And on the bottom line, it's beat expectations well into the double digits. Yeah. They talked to increase investment on brands in the next 6 months, but still with that, you still expect analyst expectations upgrade for the full year. And also there's a couple of really promising things inside the slide. They talked to the Chinese label actually doing quite well in China. Yeah. And not only they have penetrated the top tier city, a lot of growth actually come from the second tier city, which means the brand is being well recognized even into the second tier city, which means they're really well on track to. And
they're big cities, the second tier cities.
Oh, they're huge. Yeah, they say they're well bigger than our Sydney or Melbourne. Yeah. So there's a huge amount of population, and that is very, very promising for the brand recognition for A2. And they should be investing in the branding in the next 6 months. And even with that, the result is really positive. So that's very positive for the stock. Yeah. Still, again, really strong balance sheet, have great brands, strong M&A appeal. So investors really looking past it.
And I guess there is another leg up eventually when the Chinese tourist comes in. I think they'll still keep loading up their suitcases with A2 milk. Do you think so?
Oh, absolutely. Yeah. And because it's interesting with those sort of infant formulas and a few other Australian brands, it's led by the brand recognition. So when there's a lot of demand coming out of the second tier, first tier, second tier city in China, people want to buy this brand. Yeah. So, previously because of border closure, people couldn't get our hands onto it. So, with the border opening today, it certainly sends some positive news flow into that channel. Yeah. I think it will do very well. Okay,
so that's one. Now, one you've liked, but it's had a rough day in the market, is Tyro Payments.
Oh, my goodness.
Yeah. But what are you seeing there? We know that the payment sector itself is copying it, but was there special news in Tyro that made the market really give it a real slugging today?
Yeah, look, it's really just increasing expenses a little bit more than expected, but very small in terms of miss of expectations. So the revenue front, it looks good. Operating metrics looks good. Just on the margin, they have increased the expenses. And also at the same time, there's a bit of a price erosion. So, because the hotels and restaurants have yet to fully open, they couldn't put the prices increase through.
Yeah.
So eventually it will come through, but it just, in this period, it looked a little weaker. But look, I think you're very right. Majority of reason for it to be down is essentially investor sentiment. People are shying away from the payment space. You look at Afterpay's down, Afterpay or the block. Square share price down 8% on pretty much no new news. And overnight, we saw the similar sort of, the gaming space, online gaming space was down. The DraftKings was talked to great revenue growth, but increased expenditure. And that was down 20% overnight. And today we saw PointsBet down 10% as in sympathy. So it's really just investor sentiment really shying away from not profitable businesses. Just thinking, where are they going to get future capital from? Look, this is an absolute overreaction. And the business itself hasn't really changed all that much in terms of operating metrics. It's just the investor sentiment is very capital protective at the moment.
Yeah. So for the courageous and who can wait time, is it a buying opportunity then?
Look, it is buying opportunity, but I think you probably can. Share price will take some time to recover. I tell you why, because investors sort of now sitting there thinking the entire tech sector has fallen. So which one do you buy? So relatively, you start seeing a lot of value in some of the other ones, which actually are in that profitability territory. What I'm saying is that there's probably a bit time on your side.
I wrote a piece today for the Switzer report where I said, way back in October or so, I picked up on the fact that the fund managers were starting to like energy, miners and financials. And they've had a fantastic run. And I look like a really smart guy, but I just picked it up and I shared it with our readers. And I looked at them today and I said, these are still probably reasonable plays in the short term, but you're not going to make a real lot of money out of them because the big gains have already been had.
Absolutely.
But if you want to make bigger returns and you're prepared to wait, it's going to be stocks like Xero and Tyro. And those sorts of, but you have to wait. It might be a year, it might be longer, but eventually there will be a re-rotation into those sectors. Is that a fair call?
Absolutely. Yeah. I actually think we're not too far away from it. Xero's gone from 150 to 100 with no new news. You've got SEK, it's a growth stock, but reported incredible result, incredible sort of earnings upgrade.
REA would be another one, wouldn't it?
REA, Domain, all of these businesses actually now all looking cheaper than they were before pandemic now. So, they all had a big rally. Now it's all gone to become very cheap because earnings growth is being substantial. I think the bond yield move, people talk about bond yield and, affecting valuation. That's pretty much done. And then very soon when the interest rate do started to increase and people realize it's the expectation is so much, it's too severe compared to what they actually were willing to increase. And that point you realize many of those businesses like mining and others, they're not going to grow. They already done their revaluation and they, in a way, old school, sort of old industries where they structurally they're not going to grow at all. They will shrink over time. Whereas the actual portfolio for you to future-proof them is to have the likes of Xero, because in 2 years or 3 years or 5 years time, their earning will be much higher than what they are today. So it's very important to pick it up now, and I think it's getting very, very close.
Okay, so that's for the patient investor. All right, so you've looked at reporting season. Was there a company that surprised you and you now like it for the first time, or you like something even more after reporting season?
Yeah, look, I think Treasury Wine does stand out a lot. Look at, A2 is...
But you've always liked Treasury Wine.
Yeah, I always liked Treasury Wine.
It's a confirmation.
Confirmation, and I like it even more because when, investors, I must say, a lot of investors or professional investors, they have tunnel vision and they have very short attention span. They look ahead 6 months. They can't look any further. So a few months ago, everyone's thinking, this reporting season, there might be some weakness in reallocating wine. China may not be as good. So share price actually actually has fallen something like 20-30% heading into the results.
Yeah.
And the result came, actually it was fantastic, and then looking ahead. And then now the investors suddenly go, okay, next 6 months, what sort of multiple is this company going to be on? And what sort of growth is it going to deliver? It seems that the company will trade on 19 times earnings to grow at double digits. This is cheaper than, not even Woolworth double, but Woolworth trading on 27 times and delivering probably only mid-single digit sort of growth. There's just an incredible amount of growth that's actually coming through. And you have a very high confidence they will get there because, pretty much we took out China and we've seen how they reshifted it. And the earning naturally will grow. And so, it actually looks incredibly cheap for a growth company that has good balance sheet and that has a great brand. Actually, similar sort of camp as A2 now, but a little bit far ahead in terms of coming out of its problems.
Okay. Any other company that's really made you enthusiastic?
Of course, yeah. So look, because of the valuation coming off, because share price coming off, and because of really strong results, things like SEK we talked to before, it's now it's cheaper than what it was before, and a lot of earnings growth actually is more structural because the way they change their pricing, and also there's probably a bit of a structural change in our job market as well.
Yeah.
People are less willing to take on, longer term jobs, and there's more churn in the job market, and people just want to part-time roles and things like that. So we're actually seeing a structural shift in terms of lift in volume, and also because SEK has realized its market power, it started changing the way they can tier up the different packages for the advertiser, which is similar to what REA does. If you want a premium ad, you pay this and all of that, so help you to get a candidate. So and that's working really, really well. So this company will see double-digit growth for years to come, and it's probably at one of its cheapest time in the last 5 years.
Yeah, we interviewed the CEO of Domain, Jason Pellegrino, the other day, and he made the point that they handed back their JobKeeper, and that didn't help their bottom line. But going forward, he's not going to have that kind of costing position. What do you think? I know you like REA, and I know you often like to be invested in the best in the industry, but it seems to me Domain seems to be on the improve. What are you seeing?
Yeah, look, I think given the share price fall, which is completely unfounded, share price fallen significantly on the back of what was a really good result. I think it's cheaper now than REA, and I think both company are in the buy territory because look, the listings are strong. These company can control their cost. They're spending because the environment is so strong. They spend to grab share and to continue to grow and reinvest because return on investment is really high for those businesses. And both companies have demonstrated if the condition turns, so say market becomes tough and housing market and suddenly everything dries up, they just stop spending. It's not something that's inbuilt into the business. So I think it's way overblown. It just got caught in that market shifting away from expensive growth companies into the likes of the energy and everything else. That will pass because that's just sentiment and that's very short term.
And I've also noticed that they can do just as well in falling prices because people desperately want to sell their properties, and so there's lots of ads as well. It seems to me it's unemployment is the one that can really whack a real estate market, but everything else they can do well in a rising market as well as a falling market.
Absolutely. If anything, before the pandemic, the listing, a few years before pandemic, listing struggled because the housing market was so hot that no one wants to sell. That's right. So the turnover actually reduced. So they finally recovered then, of course, the pandemic, and now sort of, they're cycling really weak comp and they're doing really, really well. So to me, the housing market is still going to be reasonable for the next 2-3 years, and that turnover is going to actually pick up for those guys, and they make such a significant return for those listings. These businesses are definitely buy.
Great, thanks for joining us.
Thank you very much.
That's Jun Bei Liu from Tribeca Alpha Plus. It's time to catch up with Paul Rickard of the Switzer report, and it's reporting season. Paul takes a close look at lots of the companies, and one in particular we're interested in is A2 Milk, which has had a really ordinary experience for about the last 2 years, but it's had a reasonable day, Paul.
Yeah, it has had quite a good day, Peter. I mean, I guess for a company that was almost a $20 stock at one stage to be down at around about $5, it's bounced up today. We're up quite strongly. Look, some good news I sense in the report, in that there was a slightly more confident outlook in terms of what the second half could look like.
Yep.
I think the first half that they announced today was pretty much on expectation, but there was interestingly enough in there, sort of in looking at the China market, there was a bit of a market share gain in terms of their so-called Chinese language milk product.
Yeah.
Not so much in the English language share, but things seem to be stabilising a little bit, so a slightly more upbeat forecast for the second half. It looks like a lot of the pain is over. Not going to be a massive recovery, Peter, but look, probably we've seen most of the pain in that stock, and I think that's what the market's celebrating.
And I guess you'd have to think, well, look, you're not going to see Chinese tourists back in big numbers until probably 2023, even later. And that's when you probably will expect the old Daiju trade to kick in again as well.
Yeah, I mean, look, maybe that starts today with some inbound tourism, but I mean, a little bit that should be positive. But the other thing going against A2 milk has been that we've actually seen a decline in the birth rate in China, quite a considerable decline over the COVID period, despite the efforts of the government to boost the population, and so maybe that starts to get reversed as the Chinese economy goes out.
They're allowing more than one child now.
They are. So a lot of very supportive policies, but the birth rate's really been hit quite badly, and I guess it's also impacted stocks like A2 milk and the whole market for infant nutritional products. So maybe as COVID unwinds in China, a bit more confidence returns, we'll start to see a bit of an uptick in the birth rate. So that should be good news. So I think most of the bad news is out in that stock, and I think that's what the market was by and large celebrating today.
Okay, what about Wesfarmers, Paul? It's copped it recently. What's
the market's been pretty hard on Wesfarmers. Look, it was probably pretty much as expected report, Peter, but it didn't have, we've seen, obviously challenges around both Kmart and Target in that part, and office work. So some of the more traditional, retail stores, just the foot traffic being down in the December half because of Omicron. Bunnings, growth slowed. It still grew fractionally, but not at the sort of stellar rate. And it was probably a result where the number came in as expected. Dividend was cut a little bit, but that's to be expected. And the market's just pulled back. So, I mean, Wesfarmers has had a pretty good, strong track record in by and large, sort of doing a little bit better than the market expected. This one was sort of, the market's where it is. We can't do much about what's going on in with foot traffic and some of the challenges in terms of supplies and getting stuff into Bunnings stores. And the market was a little bit hard. I think it's because it's a fairly expensive stock, Peter, and just was probably due for a bit of a pullback.
Yeah, and it did very well during the first lockdown, didn't it? Bunnings was...
I mean, look, Wesfarmers is, I think, a great portfolio stock. It trades on a pretty high multiple. I wouldn't say disappointed. I would say just that it didn't shoot the lights out, Pete, and a stock that is sort of trading between 50 and 60s pulled back now towards more 50 rather than going towards 60. So I think it's probably reasonable buying again where it is. Okay.
We've also noticed that payment stocks keep on getting slug, Paul. What do you think's behind all that?
That's a really good question, Peter, and it's... when you say payment stocks, this is an international trend. So that the
PayPal's been smashed.
PayPal has what Afterpay became, which is effectively now Block, and a lot of other companies. So the whole sector has derated. And look, as to why, Peter, I mean, I think we've seen markets go through sector rotations, and you could argue that everything was in love with payments 12 months ago, and suddenly the market sort of...
Are there too many competitors in the market?
Well, look, I think it's just the market's moved on to other sectors, and so when you can see a bit of selling and a few other things, and it's been accompanied by the latter stages by the movement out of tech, just because of the higher interest rates and concern about what's going on in the world, and the sector's under pressure. So look, you might say it was overvalued. It's probably moved from one extreme to the other, and it's happened pretty quickly.
Yeah. They are considered as tech stocks, and tech stocks always cop it when interest rate rise. So there's multiple forces going on there. Do you think somewhere down the track there'll be a re-rating of these stocks?
Look, I think there will. I think what we consistently see in markets, Peter, is that they fall in love with stocks and sectors and industries.
Yeah.
And it always goes further than you think. And then when they suddenly get out of love again, the out of love is pretty hard. So I wouldn't say there's going to be an immediate, let's get back in love with payments companies. But at some stage that it'll go through that cycle again. And it's gone from one extreme to, I'd say out of love pretty quickly.
Okay.
And it's not, you look at the Australian companies, but they're just caught up in a global trend. And, so very quick things there.
Now, a lot of people, look to bond funds to try and get income. And there's a listed bond fund called NBI, Neuberger Berman, and it's been recently copying it because it's on the market. What's just talk about what we're seeing there, Paul?
Yeah, so it's not the only bond fund, Peter, that's been copying a little bit, and there's a couple of others. There's one from KKR, and they've all been hit pretty hardly. What you got to remember is two things. That first of all, when interest rates go up, the price of a bond goes down. So the initial first reaction is bad. And so anyone who owns a bond fund, whether it's one of the index funds or even on a Vanguard government bond fund, those prices are all lower today than they were 3 months ago. And the reason for that is that bond rates and the interest rates and corporate securities have gone up. And because these funds all value their securities on a mark-to-market basis, it means the underlying value of the fund has gone down. So that's the bad news. Over time, there is some good news though. What it means though is you'll start to get a higher yield to maturity. In other words, your interest payments will increase because when those funds reinvest, they'll reinvest in bonds paying higher interest rates. And so the income flows back to you will increase. And
so it's a time thing, isn't it?
It's a bit of a time thing, that's right. And then, so on the long run, your income's going to increase. It's going to be a positive. And then secondly, as you've already started to see, we've seen the US, watch the US 10-year government bond, it's around 2%. In this flight to safety that's occurred over Ukraine, bond yields have gone down, prices have gone up. And some of the prices in those bond funds have actually improved the last couple of days. With NBI, look, it's just copying it in the sense that you're seeing a little bit of panic out there, and of course, where it's trading on the ASX is not what it's worth. So most of those funds have what they call an NTA, which stands for Net Tangible Asset Value.
That's the real value of the funds.
That's the real value, and that's not something that's historic. Every single day, the portfolio manager is valuing the bonds in that fund at market.
If they had to sell them tomorrow.
If they had to sell them tomorrow, what price would they get? Where it's trading on the ASX sometimes has no reflection of the NTA. And what we're seeing at the moment in terms of NBI and a couple of the others, the one from KKR is in fact it's trading below NTA. So there are panic sellers out there for whatever reason. Arguably, Peter, it creates opportunities for others because others can buy assets worth a lot more and pay a lot less than what they're for.
Yeah, okay.
So look, I think if you own those funds, I mean, if they weren't listed, you wouldn't know about it, right? Because if I would say
you just get your income every year.
I would say ignore what is showing on the ASX or where it's trading. I would go to the fund manager every day of the week is putting out an announcement to say what the NTA is, and I would be looking at the NTA and using that as my guide. And sometimes you just got to put the market price of things on the ASX to one side and say that's not really the value. That's just where a couple of people are trading at a point in time.
Yeah, it's a bit like a stock. Sometimes the market can have a very unusual value, and then within weeks or months it turns totally around based on the real criteria that should underpin a stock price. Okay, that's Paul Rickard of the Switzer Report. And that's the show for Monday. Make sure you tune in on Thursday. And if you want more information about the stocks that we look at here at the Switzer Report, go to switzerreport.com.au. I'm Peter Switzer. Thanks for joining us. See you on Thursday.